Well, good morning again, and thank you for your indulgence. This isn't the type of thing that happens regularly. It's the first time over many years of introducing Investment Analyst Society presentations that something like this has in fact happened. And I'd like to really commend the company and its investor relations that they realize that the SENS announcement has to go out first, because this is not just a broadcast over here, a discussion over here, but it's also a broadcast that is going out on TV. And it is critical that we actually maintain good corporate governance. So without further ado, let me hand over to Dr. Anna Mokgokeng, who is the chairman, who's going to do a short introduction, and then after that we'll get into the presentation itself, and we'll learn about all the very interesting things that the company Rebosis does and where it is expanding and what its strategic direction is. Thank you.
Thank you, Arthur. Once more, we apologize for the delay, but I'm sure you'll soon realize it was worth waiting for. Good morning, esteemed members of the Investment Analyst Society, our investors, colleagues, ladies and gentlemen. Thank you for joining us today as we present our company's annual results for the year ended 31st August 2015 to the market. Arthur has already introduced me, but for those who are hard of hearing, I'm Dr. Anna Mokgokeng, and I'm the chairperson of Rebosis Property Fund. And on behalf of the board of directors, it gives me immense pleasure to report yet another set of robust results in an increasingly challenging economic environment. Although we find ourselves in a rising interest rate cycle and lower than expected GDP growth, we continued our solid performance, underpinned by strong fundamentals and active management of our properties by a competent asset management team. The board has declared a distribution, which was achieved through successful yield-enhancing investments and a continued focus on containing operating and financial costs. We believe we are well positioned in the current economic environment to grow our portfolio and sweat our current assets to ensure continued solid returns to our shareholders. On behalf of the board, I would like to congratulate Sisa and his team on delivering once more such excellent results. Thank you.
Good morning, ladies and gentlemen. Thank you, Chair. Thank you, Arthur, for the introductions. Good morning to our viewers out there as well. We are pleased to announce an excellent set of results this morning. I'm going to stand here for about 5 minutes, and I'll hand over to my colleagues. Mike will take you through New Frontier results very quickly, and then Kameel will also take you through Ascension results, and then I'll come back to deal with the Rebosis results. But I'll take you just through our highlights. We're reporting a distribution growth of 11% to 110 cents per share. Our assets under management have grown by 29.5% in the reporting period to 9.8 billion. Our consolidated assets, given that Ascension and New Frontier are now subsidiaries, so we consolidate them, have grown to 15 billion. And we just make the point that post-year end, this has grown to 17 billion rand. Our net property income is up by 8%, which talks to the fundamentals of our underlying properties. The return from the UK rand hedge investment we made in New Frontier is 34.6% in the reporting period, and that's just over the last 5 months. That we made that investment at 18.25 rand to the pound when we invested in New Frontier. That was in March, and the share price currently 23 Rand 10 cents, and the Rand is also depreciated. So that gave us about 26.6% capital growth, plus the 8%, which Mike will be reporting just now. That makes up the 34.6%. Cost to income reduced by 3% to currently 13.3%, so very tight on cost containment in the company. Successful acquisition of the Ascension B units, which was consummated in June, and Ascension changed the year end also to coincide with our year end. So that was quite successful. As you know, the A units remain listed. Kameel will talk through the Ascension matters. Strategic Rand hedge investment in New Frontier, which gave us that total return to date. On that note, thank you. Mike.
Good morning, everyone and viewers. So we just wanted to give you an overview of what's happening in the UK market, slightly different from what's happening in South Africa at the moment. We have consumer confidence. It's been its highest since the 1990s. We have GDP growth forecast of slightly greater than 2.5% over the next 2 years, according to Capital Economics. We have a UK population growth by 2 million people by 2020, up 4%, and unemployment, which stands at a relatively low level of 5.4%, will also fall during that period, down to 5.1%. We've got evidence of real wage inflation of up to 3.1% year on year. We've just announced inflation figures of minus 0.1% 2 days ago, so we're seeing real growth there, which will provide further money for our consumers to be able to spend. We're seeing rising sales volumes, a rise of 4.5%. In fact, September to September was 6%. So we're seeing real growth from consumers who have higher disposable income, the ability to be able to go and spend in the shops and online. There's more tenant demand. We're seeing shorter rent-free periods. We're seeing more multi-channel options. And we will also see a benefit of a rates revaluation, which will come through in 2017, which will benefit certainly our portfolio in the north. What is our investment strategy? And what's the criteria that we're looking to acquire the assets? Well, the first thing is they have to be centres that are geographically dominant within the UK. And we were aware that some of our shareholders and investors and perhaps analysts haven't been to the UK for some time, although an awful lot of people have been at Twickenham recently watching some of the rugby. That actually we wanted to explain a little bit more detail about how shopping centres have evolved. And we asked Colliers International to do a research paper, which I believe you will have in your booklets, which we're not charging for, but it's something that we thought that was important so you can understand how shopping centres have evolved within the UK, why retailers still want to be there, why shoppers want to be there. And that's very much part of our analysis when we're looking to acquire centres. We have a minimum lot size of 160,000 square feet, so we've got critical mass. Our centres must have asset management opportunities. We're going to be buying good quality centres that also have asset management opportunities. We're not buying centres that just have asset management opportunities. So that's very important because we're very much an income driver. Our business is all about income and income growth and sustainability of that. We're looking at quality and location of asset. Very much within the UK, we have a very good public transport system. People do drive, but the transportation system is very important. We also have planning laws that very much focus on the town centres. We've got to make sure that we have an asset that's fit for purpose. We want quality tenants, and we want rents that have been rebased. Since the peak of the market, rents have been rebased by about between 25 and 30%. So we are buying assets that we understand what the true ERV is today. So that's very important to us. As a business, we have just converted to become a UK REIT. That is very important. It's something we set out when we floated and raised our first capital. That means that we have to distribute 90% of our property rental income profits that we earn. So as very much paying a dividend is very much what we want to do. We plan in the next 6 to 12 months to go onto the main listing on JSE to add further liquidity to our shareholders. The highlights of the year. Well, firstly, we set up a new business just over 5 months ago. We said that we would deliver a 7% distribution yield. We've delivered that. We've also delivered that on a come dividend basis, so shareholders that came into the Blackpool transaction who subscribed when we acquired Blackpool will get the benefit of the 7% distribution yield. Annualised net income is up 3.2%. Annualised void costs are down 9%. That will feed through to our profits going forward. We have 100% retention of our tenants where they have an opportunity to walk away from our centres. So that just shows very much how they want to be there and our ability to be able to keep them. But also, when we've been doing new lettings, core lettings, we've seen growth above our ERV of 5.1%. And also, we have quite a lot in the pipeline. We have 40 new leases in the pipeline that will improve our NOI, which will help our distribution yield going forward. Financial highlights. Distribution amount is 3.05 pence. And we have assets under management of 180 million. Net property income of 5.37 million, which is really for the first 4.5 months of this year. Occupancy is about 95%. Cost to income ratio of 15%, which is fairly standard for retail centres. I put gearing. You have gearing, we have loan to value in this particular way that we analyse things. We're at 57.7%. We have a 5-year interest-only facility from HSBC. We've drawn 102 million. We have a further 2 million to draw down for CapEx purposes in the future. And our cost of funds is 3.38%, so quite a low level in this market. Our dividend yield, as you said, is 7%, but when you take into the depreciation that you've seen in the rand, that's equivalent to 15%, which is 8.1%. The income statement is relatively straightforward, and I'm sure that you'll be able to go through that at your leisure. But we hit forecasts of the 2.75 million that we said we would do when we came out to raise capital when we started the business. Balance sheet, some extracts from there. Shareholders' equity is 81 million. NAV 0.78. That's with establishment costs, etc., as you would expect to see at this stage of our current business. And shares in issue now are 152 million. A little bit about the portfolio. Some highlights. The net initial yield of the portfolio is 6.55%, an equivalent yield of 6.38%. The WALT on the leases is just over 10 years. We have a quality portfolio with household names, Boots, New Look, Topshop, Marks & Spencer's, BHS, WH Smith, so national income. We have an average square foot. It's not something we use in the UK, but I believe it's something that investors like over here, of £15 a square foot, which is affordable in the UK. There's a little bit more detail on the WALT. Burton, you'll see, it has an exceptionally long WALT due to 2 leases to Marks & Spencer's and Primark, so key tenants who are going to be in there in our shopping centre for a long time. The gross rental income to expiry, you can see that we have 40% of our tenants' leases are going to expire greater than 2022, and we have leases in 2017, and next year of approximately 37%, which will be expiring, and we have built everything into our forecast going forward. So we are a busy team in the UK. We do a lot of active asset management. We're talking to our tenants all the time. We've been doing lettings in Cooper Square, Burton, to Boots, Superdrug, Clark Shoes. We're talking to Next, who want to upsize. So Next is an anchor tenant in our scheme. They want to upsize, and we're helping them at the moment to be able to do that. We're in discussions with BHS, who want to downsize a little bit. And also we have Primark, who are talking to us about upsizing again. So our tenants want to be in our centres, and they want to have more floor space to be able to trade out of. We're acquiring a small chapel for £350,000. It was under offer at one stage in 2008, we believe, at £2 million. So kind of shows what's happened to the market. We have a national tenant, Edinburgh Woolen Mills, who want to take a lease on that. So that will be producing a circa 10% return on cost. And our real focus here, because we don't have many voids, is actually to be able to convert some of our temporary lettings into longer term lettings, together with the asset management that we're doing as well. The Cleveland Centre in Middlesbrough, again, we've been busy. We retained HMV, slightly higher than our forecast rent. We have H&M, who I believe are opening in South Africa shortly. They want to expand and take some upper parts. The Holiday Inn has opened, 140 bed spaces. We just have a long lease here, but that provides opportunity for food and beverage, which we're working on at the moment. Pep & Co have come into the UK. They've only taken 50 units. There's a slightly more upmarket Pep & Co than you have in South Africa, I believe. That's trading well. A healthy pipeline of units under offer. So tenants, again, want you to come in. It's the back of the consumer spending, the back of the growth we're seeing in the UK, and we're seeing our retailers wanting to take more space. And we have ongoing discussions for more tenant engineering with Pound World to come into our centre. Just a quick overview. Obviously, we bought Blackpool, and this is the overall portfolio. So we have over 1 million square feet. The WALT is 9.3 years, so you'd expect that to come down because of the lease length in Burton. Quality income from quality tenants, New Look, Boots, Debenhams is our first time. We have a Debenhams. H&M have moved up there, Topshop, Marks & Spencer. So again, it's a quality income portfolio. The outlook for the business. Well, the good news is the UK is seeing good growth, good GDP growth, and that's expected to go forward. We've got continued real wage inflation and falling unemployment. Interest rates long-term are going to stay low. Our 10-year money is 1.7%. Our 5-year money is 1.25%. So there's no signs that we're going to see big rises in interest rates within the UK. We've got a very good backdrop for rental growth and yield compression within the UK. We are seeing increased tenant demand. You can see that by some of the examples I've shown already for quality space that we're providing. And we expect to see further value and yield enhancements going forward. We'll be certainly acquiring more properties. We're looking at a number at the moment, and we'll obviously talk to our shareholders in due course. We're pleased to be able to provide a forecast on our dividend growth going forward, and we expect to see our dividend grow by somewhere between 7% and 9%. So thank you for listening with me today, and I'll pass you over to Kameel.
Thanks, Mike, and welcome to all. So I'm here to talk about the Ascension results. Just recently been appointed as the CEO, so it's effective 1 October. Just a precursor to the financial highlights or key highlights for the business. Results are representative of a 2-month period. Why the fragmented year? We had a financial year ending 30th of June. However, Ascension decided to, obviously, in context of the group, changed the year-end reporting into 31 August. So as a result, we're only reporting on 2 months. There also was a clean-out distribution, as most of you are aware, that was published into the public domain. The clean-out distribution was representative of the Rebosis acquiring Ascension. Rebosis acquired or had the intention to acquire 100% of Ascension. The B shareholders voted in favor. However, the A shareholders voted against. What did that mean for Rebosis? It acquired 59% of the company. So some of the key highlights. For the 2-month period, there's an annualized distribution growth of 10.3% on the B shares. Obviously, the A shares get to enjoy the full 5% year-on-year growth. Annualized, as in the 2 months taken as a comparative to the prior year. I think importantly to highlight, though, is that if we take the 2 months compared to the exact 2 calendar months in the 2014 year, year-on-year growth is 21%. There was a first interim of 2014 being behind forecast, which was normalized in the second half of the year. So as a result, 10.3% annualized distribution growth. That's complemented through a net property income growth of 10%. Vacancies, well done to our asset management team. There's been a concerted effort by the team to drop the vacancies across the portfolio. If I just use the June 2014 as the reference point, it was 8.5%. That came down to 6.5% as of our 2015 June, and currently sitting at 5.8%. So it's a key focus of the asset management team to drop the vacancies. There are still vacancies, of course, and this will be a priority and focus for the team. Assets under management, 3.8 billion. That compromises 29 properties, and I'll talk through a little bit more in the detail of the properties. In terms of 3.8 billion, that remained consistent as in what was reported 30th of June 2015. Obviously, because it's a 2-month reporting period, we used the independent valuation performed at that point in time. If I do a full year comparative, the portfolio has grown by 3.4%. It was 3.7 billion in the prior year. And then the portfolio continues to enjoy a good cost-to-income growth, a cost-to-income ratio, of 11.8%. So just some of the financial highlights, as I've mentioned. The A shares, the distribution will be 7.3 cents. That's just for the 2-month period ending 31 of August. That represents a 5% growth. The B shares equates to 4.56 cents per share. That's annualized at 10.3% growth. Market cap is 2.6 billion. Important to highlight that as Rebosis acquired Ascension and acquired all of the B shares were suspended in terms of its trading by the JSE. I'll talk a little bit more in terms of what our strategy in that regard is, but that market cap is representative of the current share prices. The B share valued at the price that it was suspended at. I've spoken about assets under management at 3.8 billion, and vacancies obviously is a key area. Our weighted average cost of debt is 8.1%. There is some debt that is coming up for expiration. I'll show you the expiry profile shortly, but obviously that is a focus of us to try and ensure that we drive efficiency in our cost of debt. Distributable income statement, just some top highlights. 67.3 million rand as it currently stands in terms of property income, net income of 57.3 million, and distributable earnings, which represents the 7.33 cents for the A share and 4.56 cents of a 39.8 million rand absolute value. So how does it look in terms of the growth profile, the distribution growth profile on the B shares? Of course, the A shares have consistently grown at 5% as they currently enjoy the 5% year-on-year growth in terms of our commitment. In terms of B shares, as of the last year, it grew by 9.8%. That's 30th of June 2014 to 2015. And as it currently stands for this 2-month period, it's a 10.3% annualized growth. Some of the balance sheet extracts. I've spoken about the value of the properties at 3.8 billion. Cost of debt is 1.5 billion. Obviously at a cost of debt of 8.1%. And then, shares in issue at the moment remain the same. There's been no further shares that have been issued, with the exception that there was the swap ratio that took place in terms of Rebosis acquiring all the B shares for a agreed upon swap ratio through the scheme of arrangement. So the current debt expiry profile, we've got 8.5% worth of debt expiring in the next financial year. We are already commenced in discussions in terms of restructuring that debt.
A significant amount of the debt of 1.5 billion, or just over 1.5 billion, expires in 2017. That's representative of 44%. And again, part of the restructuring of our debt is to look at potentially restructuring the 2017 debt as well. Okay, so in terms of the property portfolio, just want to highlight some of the activities of the last 2 months. As I mentioned, we've got 29 properties, 28 office and 1 industrial, so it's obviously an office portfolio, office fund. In terms of GLA, that means it's 93% office and 7% industrial. However, in terms of value, it's a 98% office and 2% industrial. Vacancies I've spoken about. So in terms of the office profile, we're currently sitting at 6.5% versus 1.5% of industrial, bringing us down to 5.8% for the 2-month period ending 31 August. Our cap rates for the portfolio are representative of the valuation performed at 30th of June, 9.4% on office and on 10% at industrial. And then average monthly gross rental of 102 Rand per square meter on the office portfolio. Average escalations of 8.8% for the same portfolio. And the lease profile is 3.4 years. Obviously, again, focus of the asset management team to ensure that we keep our finger on the pulse in that one. So finally, the way forward for Ascension. We obviously want the intention of management is to continue as an office fund. It enjoys the luxury of having some fantastic assets within the fund and a very strong sovereign underpin. So the intention for management is to definitely continue in that direction. The big question, I guess, is in terms of the B shares having been suspended, what is the way forward? The JSE have recommended or suggested that we should consider moving the A shares to a debt sector within the main board. What does that mean? That Ascension then gets removed as a REIT off the REIT sector of the board. Through engagement with the JSE by management, our intention is to create liquidity amongst the B shares. By creating liquidity in the B shares, we've got a commitment or agreement with the JSE that we'll be able to allow the B shares then to be relisted. Obviously, that is a work in progress through a certain amount of activity by management. But once the B shares get listed, that allows the A shares to remain listed on the main board, and then affording Ascension the full luxury of remaining as a REIT as it was trading previously. That is obviously a key focus by management at this point in time. There's a lot of activity that's happening. I can't at the moment, obviously, due to confidentiality, divulge what that activity is, but it is a strong focus and number one on our agenda. As I mentioned earlier on, I was recently appointed as of 1 October. The entire board was reconstituted. There were 2 members, independent non-executives from the previous board that have come across, and then we've appointed a number of other independent non-executives. The board now does remain as an independent board. In terms of the growth forecast on the B shares, our expectation is that we will grow between 8 and 10%. I think that's fair in terms of how the portfolio has performed for the last 2 months, and I strongly believe that we will be within that range. Thanks.
Thanks, Kameel. Thanks, Mike. Just continuing with the Rebosis results. So some of the milestones that we've achieved in the last 12 months, they include the Blood Street bridge link that we completed, linking the east and the west wing of the Blood Street, creating more fashion and introducing more fashion on the east side. As you know, it was more furniture and banks and that sort of thing. So we closed out all the furniture and introduced more fashion. The only aspect that's left is for the ShopRite to change the U-Save into a ShopRite, which will happen in the new year. We anticipate that to complete by June, but the bridge is complete, tenants are open, some amazing tenants that have open national tenants. Accelerated book build that we did in January of 565, which was 2.5 times oversubscribed. In February, we started the Ascension process of acquiring the remaining linked units through a scheme of arrangement. As you know, the voting took place. We got the B units, and the A units were not voted, and Kameel just spoke to that. We, in March, did the investment in New Frontier for 1.2 billion, which gave us effectively 62% control of New Frontier. We then, thereafter, in April, did unsecured DMTN program for unsecured debt. We had a rating for the unsecured debt of A-. On a successful debut, we were able to place 440 million rand in the market of that debt. And then in August, we had the successful scheme of arrangement effective, which gave us 59% control of Ascension. So the structure of the group now looks like this. 100% of the portfolio, which makes up of the 19 properties, 14 retail properties, 1 industrial property, and 4 retail assets, which is Hemingway's, Dansani, Sunny Park, and Blue Street. 100% of the Ascension Menco, which you'd recall we acquired last year for 150 million. 59% of Ascension properties. Kameel just spoke to this. 29 office properties, mainly let to government tenants. And then 62% of New Frontier, made up of the 2 properties as at the reporting period. They've since taken transfer of Blackpool, and they have 3 shopping centres now in the UK. Distribution growth history. We've continued on a path of growth. And to date, we're reporting the 11% growth, which is an annualized 110 cents per unit. Financial overview. So distribution up at 11%. The assets under management, 29.5%, making up 9.8 billion from the 7.6 billion. Net property income up 8%. This talks through our fundamentals. We'll walk through now the income statement, which is made up of the 603 million rand. Occupancy is slightly down, which means vacancy is slightly ticked up. We'll walk through this later. I think we've made some gains on the retail side. Retail vacancies came down from 4.1% to about 3.1%. And on the office side, that's where we've had an uptick on the vacancies from 1.3 to 3.1, largely because of a revenue building in Maritzburg, which was under a rental warranty, which management had hoped it would be let before it came out of the rental warranty from the vendor. It hasn't been, and it's in the process of being, in the next few weeks, it should be finalized. But as of the reporting period, that's the occupancy rate. Cost to income ratio, we've come down to 13.3%, which is quite, it's something that we watch very closely. Is it sustainable? We believe it's sustainable going forward. Gearing has come down to about 36.5% from 38%. Largely because of the equity raise that we've done. So we've achieved that, notwithstanding that we've actually increased our assets by 29%. Cost of debt has gone up, largely on the back of the interest rates cycle that has gone up. We've done more fixes in the process. I'll take you through that later. Distributable income statement. Extract, we spoke about the 8% to 603 million rand. Underpinned by a very good growth in our rental core income and the facilities management. You'd recall that we report the facilities management on a net basis, and it's largely the NPA component of the facilities management. We've got that lease ending in 2017, and we're quite confident they actually wanted to buy the property. You'd recall at some point that they'll continue to stay in that property, and as long as they're in the building, that facilities management income stream should continue. Operating costs, well contained. We've only had 3.6% growth in an environment where inflation slightly ticked up higher, etc. But we've been quite strict when it comes to our operating costs. Income from acquisitions, asset management fees. This is the Ascension Menco, that income. We've got an interest cost against that on the 150, as you'd recall. And then the balance is the admin costs that goes out to the asset management. The anticipated distribution from the New Frontier and Ascension, 139 million. Those are the two that make up of that. We break this down later for you. Antecedent interest, 62 million, largely because of the equity raise that was done, which entitles those shareholders to the distribution, full distribution. So that gives you distributable earnings of 572. Our net finance costs have gone up by 19% to 260 million, largely because the gearing into the investments we've made into New Frontier, etc. Our number of linked units have gone up with the equity raises that we've done to 518 million units from 386, effectively. So this was something that was quite interesting. A lot of people raised it, analysts raised it, so we thought we'll just paint the picture for you. The investment yield of New Frontier when we invested in New Frontier in March was 7%. Now, because New Frontier is a very good rand hedge for us, and with the movement of the rand, that has translated to 8%, as Mike reported. The cost of capital for that was made up of debt and equity, but the average cost was 9.2% in our hands. That 2.2% differential was a dilutionary cost in our hands of 22.4 million when that investment was made. Net income drivers. This is the first slide we're putting. First time we're putting this slide, given we're a group now. So 81% is our direct property under Rebosis company. So that comes directly from the 19 properties that we own. 9.9% comes from Ascension, effectively, and 8.9% comes from New Frontier. Now, because that 8.9% in New Frontier didn't cover the full 12 months, so we've annualized it for you, and that is 18.3% effectively. And Ascension moves to 11.8% because we only took the balance of the Ascension units from June, effectively. Before June, we were at 32%, and we went up to 59% of overall company, which is 100% of the B units. So on an annualized basis, had we had those investments for the full year, Ascension would have been 11.8% and New Frontier 18.3%, which then reduces our direct property contribution to 69.9%, which is 70% effectively. Secured borrowings. So borrowings have gone up, as we said, from 2.9 billion to 3.6 billion. These borrowings exclude the post-year end activities for the further investment in New Frontier in Blackpool. Of the facilities available, very close to that number of what we've drawn down. Average interest rate, as we said, it's gone up to about 8.2%. Our gearing ratio has come down, which is quite interesting. I think a lot of people thought, given the investments that we make in New Frontier, etc., we're gearing higher. But in fact, our gearing has come up. Naturally, our value of our investments with the revaluations have also gone up, which helps our gearing to come down further. So our debt, our fixed debt, has also gone up 73.7%. We also make the point there that as at post-year end, that figure stands at 75.2%. As you know, our policy, our steady policy, is to keep the hedging above 75%. We are actually increasing that hedging to about 80% currently. The interest cover, 2.9 times. The percentage of our debt capital markets unsecured debt is 12%. That's that 440 million I spoke about earlier. Balance sheet extract. Assets under management, 9.8 billion, which is comprised of the investment property of 7 billion. We'll walk through this later. We've got a breakdown nicely for you per assets and the yields and that sort of thing. The listed property securities of 2.6 billion, which are made up of the Ascension and the New Frontier. So if you come down here and you look at this, our makeup is 71% of direct properties, and by value, 12% is Ascension, and 15% is New Frontier. And the right to manage, that's how the asset manager is classified. So of the value of the company, New Frontier is 15%, and Ascension is 12%. Post-year end, that figure That 15% for New Frontier has gone up to 22%. Yeah. So interest, we've covered that already. It's gone up, the interest-bearing debt, and the NAV has also gone up. Interestingly, the NAV per unit is 12.94. So currently we're trading at a massive discount to NAV per linked unit. Debt expiry profile. We've got some expiry. This is as at year end. So we've just painted this picture because we've restructured the debt profile. So we had 56, which is now reduced to 30%. That's the 2016 calendar year. And 2017, we had about 16% as at year end. Post year end, that's sitting at 10.4. And the bulk of the debt sits in 2018 at 47%, and the balance in 2019. Now, this is the consolidated group extract. Given that we own 51% controlling share in New Frontier and Ascension, our assets move up to shy of 15 billion, 14.5 billion, effectively. That's the investment property. Interest-bearing, 7.2. This is for accounting purposes, really just on a consolidated basis to see the picture. Rebosis portfolio. So our property portfolio currently, 3 billion rand is the retail assets. That's the 4 retail assets, which is Hemingway's. In fact, there's a breakdown after this, which is the 4 retail centers I spoke about. Office 14, which 3.8 billion. And the industrial property of 145 million, making up that 7 billion rand. Value per square meter, quite straightforward. Industrial property always the lowest. We always make the point that some of these offices you can't replace for that cost currently, for that value currently. I think cost for some of our buildings sitting at about 30,000. So this is pretty much half of that cost. Weighted yield, 8%. It's quite a conservative valuation. You'll see Hemingway's cap rate at 7.5%. You won't buy that asset at 7.5. Certainly, if there is one available, we'll jump at it. The portfolio percentages. So retail currently 43%. This is direct property. I also make the point that if you combine the group now, our Ascension and the New Frontier investments, that retail moves up to 49% with the New Frontier. So as we stand at year end, that figure looks like 49% from a sectoral spread perspective. Okay, so on the direct properties, the office is at 55 and industrial at 2%. The GLA, 163 on the retail side. Vacancies, I spoke to this earlier, 3.1%. Last year we were at 4.1. The office is having ticked up because of that revenue building in Maritzburg that we're hoping to close very soon from 1.3 to 3.2, which gives us the average. Average monthly rental, 128 on the, this excludes utilities, so it's just your gross rent plus operating costs at 128. The office, decent 94 Rand 50. You'd recall that for us it's very important to ensure that the office, more particularly because it's government-led offices, that these rentals are sustainable and that given that we have a long lease profile in our properties, we don't have a situation where we're going to have a drop in the income downstream. That coupled with the escalation rates. So if you look at escalation, decent 8.6% on the government side. So we shy away from 10% escalations and things like that because then you're just inviting a problem later. On the retail side, average escalation, 7.4%. Weighted lease period, 4.3 on the retail, 3.6 on the office, and 3.4 on the industrial, which gives us a very decent 4.2 weighted average. Net to cost income ratio, 16.4 on the retail side. This is on a net basis. On a gross basis, that figure looks like 26%. And on the office side, 11.4%. The industrial is pretty much triple net lease, so it really look after insurance and the like. Top 10 properties by value. Hemingway's makes up the bulk, as you guys know. That has since come down. If you recall back in days, we had that at 32%. It's since come down to about 18% currently. 74,000 square meter center, costs and the valuation currently. Again, cap rate at 7.5 for a big mall like this. It's very conservative valuation. Followed by Sunny Park, 27,000 square meter center. Again, a good cap rate. It's the same cap rate we acquired the center for. Followed by Salu Building in Pretoria, Liberty, Blue Street Mall. We've just recently expanded this mall, as you guys know, with a bridge. Then the NPA building, Victoria Mhlanga, 124 Main, followed by Mdantsane City and the like. Sorry, I just forgot to make one point here. So these 10 properties contribute 80% of our portfolio net income. And they also contribute 82% by value. So we only have 19, so half the size makes up the 80% and 82% by value, and 75% by GLA. Leasing activity, this is something which I like because we get into a lot of detail around it. So if you look at retail, we had 6,600 vacancy, which is the 4.1% vacancy that I spoke about. The renewals that, the lease expiries, 16,726 that came up in the reporting period. Now, that was largely Hemingway's and Blue Street leases that came up during this period. The new lettings, the lease renewals that we did, 14,600, which is about 86% success rate on that. Generally, we get close, to close to 100%. But we had particularly, you guys would recall that we had the Able situation. So we terminated some of the leases because the Able situation, largely it was Weatherly's, Furniture City, Ed Hemingway's, and then some of the lease termination in Mdantsane had a lot of furniture of Ellerines and that sort of thing. So we've since replaced all those boxes in both malls, which is quite commendable to the leasing team. The new lettings that were done, 6,000 square meters in the reporting period, which then gave us a very decent closing period of 3.1% on the retail side. So notwithstanding the fact that our vacancy has increased from 2.4 to 3.2, we've actually made some gains on the retail side. So just to give you an idea, some of the new lettings that we've done, Hemingway's, for instance, we fitted a lot of new shops, G-Star, that opened last year at some point. It was the highest trading G-Star, I don't know what the latest stats now, in their portfolio. It overtook Gateway. I think I made the point the last time. At home living spaces, they do have at home already in the center, trading very well. The high income categories tend to trade very well in the mall. So at home living spaces was added upstairs where the Weatherly space was. The Volpes also opened their sort of block, a new brand by Foschini Group for the young, also opened their Edgar's Active, and a couple of other brands that really opened. We've got Fabiani that's about to open as well, that's busy shop fitting. And perhaps I can talk about post-year-end activities as well, because we've had the Platinum Group that went into business rescue. They had 5 shops in Hemingway's. We've since replaced 3 of their shops. They're busy fitting, and we've got 2 other shops that we're busy with. In between those 2 shops, there's a big void, which leads to escalators and lifts. We want to close it out and create a bigger space for somebody like Zara or H&M and et cetera. We're talking to all of them at the moment. So that's something that's quite exciting at Hemingway's. On the office side, we had 3,300. You recall that 3,300 is at Upper Square. We had that COJ tenant that left those premises, which is a consulting arm. We're in the process of trying to close that as well. We had 1,700 lease expiries on the office side, and we renewed those. And we also had this rental warranty at the Revenue Building, which I mentioned to you guys, which then increased our vacancy for the office side to 3.2% or 7,000, or just shy of 8,000 square meters. So we have in total 13,000 at 3.2% for the portfolio. Tenant profile by GLA. I think given the large office space, we have DPW, which is made up of various departments within the government space. making up 33%, followed by provincial DBW. I think of interest in the slide is the fact that EdCon occupies only 3.2% of the overall space. I think people have been concerned about EdCon, and it's something that we're watching very closely, but they occupy 3.2% space. And in our portfolio, we've had the ABLE group that had issues, and we've replaced all their boxes in our portfolio across, which is quite something. So, in the event of an EdCon fallout, we have only 3.2% of the space to them. Overall lease expiry profile. So we have 13% of the retail coming up. This is, just bear in mind, calendar periods, not year-end periods. So 13% of that coming up in retail, and that's pretty much made up of 6% of Hemingway's leases of GLA. Blue Street, about 7% of Blue Street. The big ones are in Mdantsane, 26% of the GLA, and Sunny Park, 23%. These tenants have been trading very well. Sunny Park, they've been trading for years. They've renewed over years, so there's no issue there. Mdantsane is mostly the 3-year tenants, which had already renewed and are due for another renewal now. So there's potential for an upside for us. Rent to sales looking very low in Mdantsane, just about 5.5%. Rent to sales, they're on a very sustainable path, so we have no issues around, and we'll talk through the trading densities. We've seen very good trading density growth, which talks to the profitability of the retailers in those centers. And then next calendar year, 2017, we have 9% of the retail coming up and 21% of the office coming up. So that office pretty much is the NPA Victoria Mhlanga building I spoke about, together with SASA building in Mafikeng. We've got a building in Mafikeng leased to SASA. There are some other very small ones, but that's pretty much those two. Tenants have been in those buildings for years. We don't anticipate, we are constantly in talks with them. We don't anticipate them moving. Certainly there's no equivalent buildings that they could move in. Geographic spread. We now have, by value, in the Gauteng, which is the mainstay of our economy, 67% exposure, and the Eastern Cape, 28%, which is pretty much the 2 shopping centers in the Eastern Cape, and the balance, 3%, KZN, 2%, being the Northwest. By GLA, 66%, which is very similar to value, and by net income, 70% coming out of the Gauteng. Sorry, just perhaps just talk you guys through the sectoral spread. I spoke about it earlier. We had the retail on the direct property at 43% shown. As at year end, on the assets under management, retail is 49%. Subsequent year end, the retail is notched up to 53% exposure. Trading densities. This talks through the profitability of our retailers. These trading densities have grown up quite significantly, certainly if you compare them to market. We've seen quite good trading density growth. Hemingway is sitting at 28,389. That corresponds with turnover growth of about 10.5 there. Mdantsane at 28,425, which is 11.4 on what's reported last year. Blue Street at 33,282, and Sunny Park at 35,000 trading density. Prospects. Our portfolio fundamentals remain very strong. Certainly, we've seen good rental growth in the reporting period. We've seen cost containment, which boosted our net income quite strongly. Improved scale and liquidity from New Frontier and Ascension. We believe that with the scale that we're able to get and the growth that path that those 2 subsidiary companies are in, we'll be seeing more scale and liquidity growth into Rebosis as well. More particularly given the scarcity of the assets in South Africa and the tepid growth that we're seeing in the economy. Ascension, positioned as government-focused fund. Kameel spoke about this earlier. It is our board's strategic intention to now introduce the Bs and create the liquidity. It is a panacea to the keeping of the A's listed on the JSE, as Kameel spoke to it. It's important for us that we then do go back and create that liquidity. Why do we keep Ascension? We'll keep it as a government-focused fund. Does it mean that we may sell some of our assets in Rebosis that are government-focused and keep Rebosis with the strategic intent of it being diversified but with a retail focus? Yes, that's what it could mean down the line. The board hasn't made a call as to which assets you may want to sell at this point in time, but Ascension will be a government-focused fund going forward. So we'll have a sovereign underpin with far more defensive nature that we see under Rebosis. New Frontier continues to serve us well as a rand hedge. You've seen from a distribution perspective that's come through, and certainly from a capital appreciation perspective. Retail vacancies have reduced on the back of good retail performance. We see that going forward happening. Certainly we're busy with a lot of new tenants on the back of very strong tenant demand in our shopping centers. I didn't talk about the actual vacancies in these shopping centers. If you take where Hemingway's started in the reporting period, prior to the reporting period, the Hemingway's vacancies were sitting just shy of 6%. They're now sitting just shy of 4%. Mdantsane, because of the Ellerines issues that happened there on the furniture side, it shot up to about 6.5%. That's come down now quite drastically to just around 3.5%. The Blue Street has 0 vacancy, and Sunny Park is about 2.5% vacancy. We're seeing a lot of tenant demand, so that we see that going forward coming down nicely. Distribution growth focus of between 8 to 10%. And that's my presentation. Thank you very much. I suppose what I'll do is if we'll have 1 or 2 questions. We've run out of time, unfortunately. We started late. We are available thereafter on one-on-one. Thank you. No, it's okay. I'll just wait if there's any questions. Okay, in the absence of any questions, I suppose we are available, the whole team, let's chat on one-to-one during tea. Thank you very much.